Good morning. It is Friday, April 1st, first day of a new quarter, last day of the week. So we're just going to jump right in and get it started today because there is a lot to talk about. We will hit the employment report. Tom is reviewing it as we speak. But we're just going to get started a little bit on the Russia-Ukraine because there is some news out of Russia and Ukraine this morning. The big news, however, from yesterday was that stocks did fall on the last day of the quarter. The S&P 500 nosedived into the close to finish down about 1.57%. What's interesting here is that traders are actually pointing to a massive quarterly options trade from a JP Morgan fund that exacerbated some of this market weakness. This created a big, what they call gamma, which is when options prices change and you have to re-hedge your position because you become the hedge ratios change as things adapt. If you have more questions on that, we can talk about it. It's beyond the scope of this call. Bottom line is they bought $19.8 billion of notional value of calls. They also bought some put spreads. And as the market evolved throughout the day, that happened at 11 a.m. And as the market evolved throughout the day, they had to constantly adjust those hedge ratios in order to make sure that they were actually effectively mirroring the S&P 500. This is part of the JP Morgan Hedged Equity Fund. The fund is a $19 billion fund. And again, they just did a $19.8 billion trade for options that expire in June. The fund holds a basket of S&P 500 stocks along with options on the benchmark index. It resets its hedges once a quarter. So we saw a massive hedge this quarter, and it seems like they had to adapt some of those hedge ratios. So that's what accelerated the move. I think we were probably going to be down yesterday anyway, but when that trade hit at 11 a.m., and it kind of just exacerbated a lot of the moves that were already in the market, and there was a lot of selling pressure into the close. However, we are recovering some of that this morning, up about 50 basis points. At least that was before the economic data came out. I would imagine we're about there right now, and we're up about 46 basis points for the day on the futures. In terms of Russia-Ukraine, there is some news out of Russia that Ukraine has sent some helicopters over to a fuel depot in Russia territory and actually bombed that fuel depot. Vladimir Putin has been briefed. The Ukraine foreign minister says he doesn't know what's going on with that because he is not a party to military matters, which basically seems like, yes, this actually did indeed happen, which is an interesting move, and it'll be interesting to see how the Russians respond to an attack on their own territory. It seems to me that this might be one step too far by Zelensky. I'm curious to see where that progresses. In terms of negotiations, I think we are continuing to see some very slow, stuttering movement forward on negotiations. The Russian foreign minister, Sergei Lavrov, said that peace talks need to continue. He says that Russia has seen, quote, much more understanding of the situation in Crimea and the Donbas from the Ukrainian side, and the Russians are preparing a response to Ukraine's proposals. This came before the news of the attack. However, it does seem that Russia is saying there's a higher likelihood Ukraine will cede those territories. Meanwhile, Ukraine says that talks with Russia continue in an online format. What's interesting is if you look at there's really two wars going on. You have the Russia war in Ukraine, and then you have a separate one where you have this economic war from the West against Russia. Right now, Russia is now requiring payment for gas in rubles, and they've said that this is irreversible. What's notable here is that Bloomberg Economics actually put out a report that they said that Russia will earn $321 billion from energy exports this year, and that's up nearly a third from 2021. They're going to run a current account surplus, which is going to be a record for them, a $240 billion current account surplus. And the IIF continues to say, with current sanctions in place, substantial inflows of hard currency into Russia look set to continue. The only thing that really would disrupt this would be an embargo on energy sales. You see the US and the UK releasing more oil into the market, trying to depress those oil prices, obviously for their own electoral benefits at the gas pump, but also in order to reduce the amount of income that Russia receives from selling that oil. What's notable is that Russian stocks are up 34% since they invaded Ukraine. The ruble has actually gone up in value versus the US dollar. It's appreciated by 2%. And I think that may be a little bit misleading because you did see Russian stocks fall and you did see the ruble fall before the invasion. So I'm not saying that the invasion was good for the Russian economy, but I am saying Russia seems to be winning the economic war versus the West, but is losing the hot war against Ukraine. So it's kind of interesting because I would have thought that that would have been reversed. If you had told me last month that Russia would be winning the economic war and losing the hot war, I would have thought you had it backwards. So I think that's an interesting point to consider, especially as we contemplate more sanctions against Russia. With that, Tom, I want to throw it over to you because we are going to shift now to economic data and data that's important to markets. And that starts with the Eurozone CPI numbers, the inflation prints that we heard earlier this morning.
Yeah, sort of as a knock-on effect of Russia winning the economic war, I think we're seeing that feed through this morning into the Eurozone CPI. So it was already high to begin with. Last print in February was 5.9%, and the expectation was already for a pretty significant increase. The expectation this morning was that the print was going to be 6.7%, and it came in at 7.5%. So the expectation was a 0.8% increase, and they actually got double that. In terms of where the inflation is really bleeding through is obviously energy costs, associated with all of the Ukrainian issues and the Russia sanctions. So that's a clear indicator that the sanctions are backfiring a little bit on the Eurozone. And it really lends itself to what Christine Lagarde was saying earlier this week, which is that they're probably going to have to get more aggressive. And as a result, growth is going to be severely impacted. And I think that we're looking at a new normal of hawkish, aggressive central bank activity if we're going to see inflation come down. And so it's not a great number. The core was only up about 0.3%. So, everything ex food and energy was not too bad, but the energy piece is really, really factoring in right now in Europe. Other noticeable data we got was the manufacturing activity, basically their version of the ISM. So it was at 56.5, down from 57, and the expectation was 57. So that's actually fairly positive. Again, anything over 50 is considered growth. So 56.5 is a very strong number. It's not what they were expecting, but given that everything that's going on, the fact that they've still got strong manufacturing growth is a very positive indicator. So it's not crippling the economy, but inflation is definitely coming out of control. And I think that, given the landscape we see here in the US, given the landscape we're now seeing in Europe, the expectation for higher rates has to be considered. And as a result of the information we got, both on the employment report and CPI, we saw a real tight squeeze on the 210 spread. We were at about 0.9, so not even 0.01% difference when we got in here this morning. And then now we're looking at rates, and we are now inverted by 2 basis points on the 210s again. So we're seeing a persistent push towards a yield curve inversion. And we talked about that a little bit earlier in the week, that's not necessarily a positive signal, but typically the market, if we are going to be in a situation where a traditional inversion leads to a recession, we should see very strong markets, at least for the next 6 to 12 months before an ultimate hard landing on Fed activity. But, whether or not that really plays out is tough to say, but that's typically the move you see. In terms of the expectations for rate hikes, we're looking at 9.3 now for the year. We wavered a little bit towards the middle of the week as the markets were looking stronger. We got down to right around 9 for the year, but we're ticking back up on the information this morning. And I would expect that we're going to see some relatively strong action from the Fed, at least over the next couple meetings. If that means multiple double hikes, it's definitely on the table now, particularly with the jobs information that we got that we'll get into here next. So interesting morning in terms of the rate situation. It's been a tough start for the year for bonds, and I expect that's probably going to be the case going forward.
Yeah, thanks, Tom. I'll just give the headlines here on terms of the employment report, and then we can talk a little bit about the market impact and then the potential consequences going forward. So, in terms of the employment report, we did get that big monthly jobs number. This is the government data. We had the ADP employment report on Wednesday. In terms of the government data, though, it looks like we did come in a little bit lighter than expectations in March, up 431,000 jobs. The estimate was for 490,000, but we did get an upward revision from last month. So net, it's actually reasonably in line. That was revised higher to 750,000. So if you look at it month over month, you do see a little bit of growth slowing in the month of March. Recall that this survey takes place the second week of the month. So this is right in the hotbed of when the Russian war and the invasion was really taking place. And there was some significant uncertainty. You were seeing oil peaking at this time. So frankly, I'm not terribly surprised that we saw a little bit of lighter number. I think the underlying jobs numbers and the underlying economy suggest that 431 may be a near-term low. We'll have to see what happens in coming months. But the unemployment rate fell to 3.6%. The participation rate ticked up a little bit to 62.4% from 62.3%. So people are getting jobs. And I think that's a really positive thing. If you look at the internals of the employment report, you're basically in line with where we were last month, just at a different scale. So again, we added 431,000 jobs as the preliminary estimate from March. We added 750,000 in February. And if you look at that on an industry by industry basis, and you scale it down, we're generally seeing the similar trends. A lot of growth in retail, a ton of growth in professional and business services, good growth in leisure and hospitality as well, 112,000 new jobs in leisure and hospitality. Meanwhile, the goods producing sector of the economy was 60,000, down from 102,000 last month. That was primarily driven by a little bit lower hiring in construction. That was down to 19,000 from 57,000 last month. What's interesting on this report that probably won't get talked about, but I definitely want to bring it up, you saw an increase in the number of jobs for motor vehicles and parts. That is up 6,000 in the month of March. That may not sound like a lot, but it was down 16,000 last month. This suggests that a lot of the shutdowns that we may have seen because of supply shortages and challenges, those are easing now, and we're starting to get people back to work and actually producing cars. So you may see some amelioration in some of these used car prices, and we've talked about that before. But with that, I'll turn it over to Tom. Any comments on the overall employment situation, and then what's the bond market doing with this?
I think in terms of the overall employment situation, I think we're still seeing what I would argue is a super hot jobs market where, the Fed has basically said they're not even looking at that. It's so strong, they don't even have to worry about it. And I think that rings true, even though this number was a little shy of the expectation. I think it's still a very strong number. I think that we're basically back to pre-pandemic levels of unemployment. And one number I saw flash across the screen here is we're now at the lowest level of what they would call temporary layoffs and furloughs since the pandemic began. So I think that's a very positive number as well. All the people who were furloughed, people like pilots, people who have been basically sent home without pay but not fired in lieu of firing. That number has come way, way, way down, which I think is very positive. Wage growth was very strong. In liftoff and taper 1.0, that was a big number, was the fact that even though they were about to lift off, wage growth was just stagnant, but we're not seeing that this time around. We're basically at the point where there are double the number of job openings as there are unemployed people by the metrics that they use, which means that we're probably going to continue to see wage growth as people shift from being underemployed to some of these other job openings or potentially moving in order to obtain higher wages. I think that the jobs market, based on the information I'm seeing, can withstand higher rates. And so the Fed, I think, in turn, is going to raise rates. In terms of the bond market, let's take a live look at what's going on there. I mean, it's pretty much red across the board, more so on the short end than the long end. We're inverted on the 210 spread still. It's not quite a full basis point, but we're still holding that level. The 5s, 10s is inverted by 13 basis points. So you're getting a lot more yield on a 5-year bond than a 10-year bond. And then the 20s, 30s is also continues to be inverted. So it's just a very lumpy sawtooth sort of yield curve right now. It's a formation that I've not really seen in my career, but it's definitely interesting. It provides opportunities, all over the place for us to replace bonds as they come due. And today is one of the biggest redemption days of the year for the bond market. And so we'll have a ton of bonds coming due. All that cash will hit on Monday because you get your principal back 2 days after the actual maturity date. So we'll be putting a lot of money to work. We'll be improving yields. We'll probably be able to increase credit quality with the bonds that are coming in. But it's just a very tough market. It's very unusual, but there's definitely opportunities all over the place. So in terms of new bonds, we're getting stuff we haven't seen in a long time, really since March of 2020. In terms of old bonds, they're going to look pretty rough until they mature, but we're not losing money on bonds. We know what we're going to make when we buy them, and we try to buy the best bonds. And even if they lose a little bit of principal value, we're getting them back at par anyway. So that's really irrelevant in terms of the long term. But in the short term, you're going to see a little bit of red on the portfolio statement in the bond department.
Thanks, Tom. And just following on for that conversation, right now we are at 1.82 is the current implied probability of rate hikes in May. On May the 4th is the next time that the Fed will meet. So expect a 50 basis point or 0.5% raise of the interest rate at that point in time. Again, that's the very short-term federal funds rate and what they're targeting on that. So I would expect that to happen. I expect 2 hikes or double hike, a 50 basis point hike at that time. And I think that this jobs number continues to support what the Fed is seeing. And by and large, I think that it's not really, I'd love to come on here and make a big call and say that this has changed things, but I don't think things have really changed as a result of this jobs number. I think that the market continues to remain, the economy continues to remain in growth mode. And I think that's good news. And I especially think that it's good news that we were able to actually gain some motor vehicle jobs this month in contrast to last month. That's a nice step in the right direction. So hopefully we'll be getting to a point where we can start to see some of these supply chain issues normalize. We're starting to see a little bit slower speeds in terms of transportation of goods, which is good because it means that there's less urgency in getting the goods to and from different places, and it should allow things to settle down a little bit. So we'll see what happens with that. Overall, I'm reasonably pleased with the inline jobs report. We'll see what happens in April. But for that and for the Q1, and we'll leave it there and hope Q2 gets off to a good start. Thank you for joining us, and we'll see you here on Monday.